Hey everyone, welcome back to We Are Cosmic, the place where we break down the biggest moves in crypto and finance in a way that's easy to understand. If you've ever wondered why some digital assets seem to move quietly behind the scenes while others make headlines for hype or panic, then today's breakdown is going to blow your mind. We're diving deep into XRP, not just the price, not just the charts, but the real mechanics behind why it exists, how it works, and what it could mean for the entire global financial system. Here's the thing, what if I told you that one digital asset has the potential to touch every dollar moving across the world? Not as a guess, not as speculation, but as a built-in structural feature of the system itself. That's exactly what XRP was designed for. Some people call it controversial, some call it centralized, and some dismiss it as just another crypto. But the truth? XRP's design isn't about hype. It's about functionality, liquidity, and bridging the old banking system with the new digital future. Now let's start simple. XRP's total supply is 100 billion tokens. That's not random. 80 billion went to Ripple Labs, and 20 billion stayed with the founders to kickstart the ecosystem. This massive initial allocation is often misunderstood. Critics called it a security. Others called it necessary for institutional liquidity. But here's what you need to understand. The founders didn't want XRP to work like Bitcoin, where coins are mined slowly and unpredictably. They wanted instant, ready-made liquidity to replace outdated systems like SWIFT and move trillions across borders. And here's where it gets interesting. Ripple didn't just hold on to its 80 billion XRP as a slush fund. They created a strategic reserve, a treasury to manage liquidity in a controlled way. Early on, some XRP entered the market to form partnerships, but most stayed locked. This created anxiety for retail investors, but the truth is, Ripple was building a systemic backbone for global finance, not chasing short-term profits. By 2017, Ripple made a game-changing move. They locked 55 billion XRP into a series of escrows governed by smart contracts, meaning the blockchain itself controlled monthly releases. 1 billion XRP is released every month, but if it's not used, it goes back to the queue. This isn't hype. This is controlled liquidity, giving institutional partners confidence that no single entity can flood the market unexpectedly. Think of it like a central bank, but digital and transparent. Here's a question for you. If XRP hit $1,000 tomorrow, would you sell it all, or would you hold it knowing it's a utility asset for global finance, not just an investment? Drop your answer in the comments, because this is the type of conversation that separates casual traders from strategic thinkers. In 2026, XRP isn't just a coin, it's a financial engine. Its price, its distribution, and its supply schedule are all designed to handle trillions of dollars of liquidity every hour. That's not hype, that's engineering. So buckle up. In this 6-part series, we're going to break down XRP like never before. From its genesis block in 2012 to the multi-decade escrow strategy and the role it plays in reshaping global payments, we'll cover it all. By the end, you'll see why XRP isn't just a crypto, it's potentially the backbone of a new financial world. Before we dive deeper, make sure you hit that subscribe button and ring the notification bell. Why? Because when we unpack the next parts, you'll want to be here for every insight. We're talking numbers, strategies, and real-world mechanisms that retail investors rarely see. Trust me, this is going to change the way you think about crypto forever. All right, now that we've set the stage, let's go deeper into how XRP started and why it's not like Bitcoin or other cryptocurrencies you may know. Unlike Bitcoin, which was born through mining and scarcity, XRP was created all at once. Back in 2012, Ripple launched the Genesis block, producing 100 billion XRP tokens in a single moment. This wasn't accidental. It was a calculated strategy to give Ripple enough liquidity to build a bridge between legacy banking and the future of high-speed cross-border finance. Here's how those tokens were distributed. 80 billion went to Ripple Labs and 20 billion stayed with the founders. That 20 billion wasn't just a gift, it was the seed capital for partnerships, ecosystem development, and early operational incentives. Think of it like planting the foundations for a global financial engine. This allocation has sparked debate for over a decade. Critics called it centralized and potentially a security, while supporters argued it was necessary for institutional adoption. Both sides had points, but here's the reality. Ripple needed a large, ready-made pool of value to grease the wheels of global finance. In the early years, Ripple didn't just sit on this massive treasure chest. They used carefully planned distributions to form partnerships and pilot programs with banks and financial institutions. Unlike a typical crypto that relies on slow, unpredictable mining, Ripple's approach was strategic, fast, and scalable. The system was designed to ensure that when banks or payment providers needed liquidity, XRP would be available in significant volumes without causing chaos in the market. However, there was a problem. Because there was no formal release schedule at the beginning, market anxiety grew among retail traders. Seeing a large entity hold most of the supply naturally created fear of sudden dumps. But the truth is, Ripple was not trying to manipulate prices. They were building infrastructure, a new global financial plumbing system, and that required control over supply and timing. Between 2012 and 2017, Ripple quietly distributed XRP to partners while the majority remained locked. During this period, only a small fraction of XRP entered the public market. The timeline of these early allocations shows how the company carefully balanced internal needs with external liquidity requirements. It was about ensuring adoption, not short-term profits. Banks and financial institutions don't just accept assets without predictability. They need confidence that the asset can handle billions in transactions without the risk of sudden supply shocks. By 2017, Ripple introduced a major innovation, the escrow system. They locked 55 billion XRP into cryptographically governed smart contracts. Each month, 1 billion XRP is released, but if it isn't needed for operations, it is automatically moved to the back of the release queue. This wasn't a marketing stunt. It was a structural necessity. Institutional partners demand predictability, and this mechanism gave them the certainty to adopt XRP at scale. The escrow system also changed market psychology. Retail traders often see 1 billion XRP unlocked in headlines and panic, thinking Ripple is flooding the market. But in reality, most of the unlocked XRP gets relocked, leaving only a portion for strategic use. This practice has turned what was once a multi-year plan into a multi-decade strategy, ensuring XRP remains a stable and reliable liquidity tool for banks. What this means is simple but powerful. Ripple isn't just holding XRP. They are managing the world's largest private liquidity pool with the precision of a central bank. Every move is calculated, every release is strategic, and the goal is clear: to become the bridge asset for global finance. So when you hear arguments about XRP being centralized or controlled, remember this: the system was designed from day one to manage trillions of dollars in value. The early years, the initial allocations, and the escrow system were all part of a grand plan to create a crypto that could actually power the world's financial network, not just serve as a speculative asset. Now that we understand how XRP started, let's talk about one of the most important aspects of Ripple's strategy, the escrow system and how it controls liquidity. Many retail investors see headlines like 1 billion XRP unlocked and panic, thinking Ripple is dumping its massive holdings on the market. But the reality is much smarter and much more controlled than that. In late 2017, Ripple locked 55 billion XRP into smart contracts called escrows. These aren't just regular accounts, they are programmatically governed by the blockchain. Each month, 1 billion XRP is released automatically, but here's the clever part: if that XRP isn't used for Ripple's business, it is relocked at the back of the queue, extending the release schedule. This simple system ensures that supply remains predictable and controlled, which is exactly what institutional partners like central banks demand. Banks won't touch an asset where the largest holder could flood the market without warning. This setup has a few key benefits. First, it removes uncertainty. Retail traders often panic when they see unlocked XRP, but in reality, Ripple is using these tokens strategically. Recent data shows that out of the 1 billion XRP unlocked in January 2026, about 700 million were immediately relocked, leaving only 300 million for actual use. This consistent relocking has effectively stretched what was once a 55-month plan into a multi-decade liquidity strategy. That's precision the crypto world rarely talks about. Second, the escrow system allows Ripple to function like a central bank, but for a global digital currency. They aren't just holding XRP, they are managing a massive liquidity pool that supports billions of dollars in cross-border transactions every day. This is why XRP isn't just a speculative token, it's a utility asset designed to power real-world finance. Here's where most people misunderstand XRP's price. Many retail investors expect a low price because they see a large supply. But if XRP is meant to move trillions of dollars across global corridors, a low price actually represents a technical failure. Think about it. You can't send a $10 billion payment through through a network that only has $1 billion liquidity without causing massive slippage and inefficiency. In other words, XRP's price is not just a reflection of market sentiment, it's directly tied to the volume of transactions it must handle. This is also why Ripple's strategy of gradually releasing tokens from escrow makes sense. They aren't dumping to manipulate the price. They are aligning supply with demand from the biggest players in global finance. Retail investors are focused on FOMO and short-term price swings, but Ripple is negotiating the entire global payment system behind the scenes. That's a completely different scale. To put it simply, the vast majority of XRP is not sitting on exchanges for retail buying. It is locked in institutional agreements, part of the operational reserves, or moving through on-demand liquidity corridors. This creates a two-tiered market, one for retail and one for institutional players. Retail supply is tiny compared to what Ripple manages for banks, central banks, and payment providers. The result? A supply squeeze that most investors haven't priced in, but one that is critical for XRP's long-term valuation. Finally, this explains why Ripple's escrow strategy is so unique. It transforms XRP from a simple cryptocurrency into a foundational infrastructure asset. The price of XRP isn't just a number, it represents the capacity to move massive amounts of value safely and efficiently. The higher the price, the easier it is for banks and institutions to operate without creating market disruptions. Low prices would limit utility, while higher prices unlock the full potential of XRP as a global bridge asset. Think about how money moves today. The SWIFT system, which banks have relied on for decades, is slow, expensive, and fragmented. Ripple's vision with XRP is to replace that system with a hyper-liquid, real-time network. Every cross-border payment, every settlement, and every corridor between banks could theoretically pass through XRP. And if you consider the total value moving globally, we are talking about trillions of dollars per year. Ripple's XRP supply isn't just an investment, it's the fuel for this massive system. Here's the key, the majority of XRP isn't on exchanges for retail traders. Instead, it's earmarked for banks, financial institutions, and large payment providers. These are what we call institutional corridors. When a bank needs to move billions, they don't buy on a public exchange. They tap into Ripple's reserves. This creates a two-tiered market, a small retail float and a massive institutional layer, which is where the real value lies. The $40 trillion figure you've heard isn't arbitrary. It represents the total potential value of global liquidity corridors that Ripple has been building for over a decade. To reach that number, XRP would need to settle between $400 and $1,000 per token, depending on adoption. At these levels, XRP wouldn't just be a speculative asset, it would become the largest asset class on the planet, surpassing gold, real estate, and even global M2 money supply. The reason? XRP is designed to absorb and move the daily volume that the SWIFT system currently handles. Let's break it down further. Ripple's escrow releases are carefully timed so that liquidity matches institutional needs. For example, out of 1 billion XRP released in January 2026, 700 million were relocked, leaving only 300 million for operational use. This isn't about creating hype. It's about aligning supply with global demand. Retail investors often panic over unlocking events, but in reality, the market sees almost no impact because the bulk of XRP is moving through pre-negotiated institutional pipelines. Now consider the technical necessity of price. A cheap XRP is actually a limitation for global payments. Imagine a central bank needing to settle a $10 billion corridor. If XRP trades at $1, they would need 1% of the circulating supply for a single transaction. At $100, they only need 0.01%, preserving liquidity and reducing market disruption. Higher prices make XRP more efficient as a bridge asset, not less. This is why Ripple's strategy isn't just holding tokens, it's structuring a financial engine that requires XRP to be valuable. The higher the price, the better it functions for global payments. Retail investors see volatility, Ripple sees utility, efficiency, and scalability. The more global adoption grows, the more this floor price is supported by actual transactional demand rather than speculation. Finally, this explains why XRP's institutional adoption is accelerating. From BRICS nations seeking alternatives to the dollar to the EU's instant settlement initiatives, Ripple has strategically positioned XRP in corridors that weren't even considered 5 years ago. As of 2026, XRP is no longer a fringe digital asset, it's moving into the center of a multipolar global financial system. Banks, central banks, and large payment providers are no longer experimenting. They are integrating XRP as a primary liquidity bridge. By now, you understand XRP's genesis, its escrow system, and its role as a global bridge asset. But here's where most people get confused. The circulating supply of XRP is not what it seems. Retail investors often look at tracking sites and assume the market float is freely available. That's far from reality. The vast majority of XRP is locked in institutional agreements or operational reserves, creating what we call a two-tiered market. Let's break it down. In 2026, the XRP ecosystem is split into three main segments: retail supply, the XRP that is available on exchanges for everyday traders like you and me. This is actually a small fraction of the total supply, often less than 10% of the 100 billion tokens. Institutional reserves, XRP that Ripple has earmarked for banks, payment providers, and central banks. These are the high-volume pipes that move billions of dollars, often bypassing public exchanges entirely. Operational treasury, Ripple's own holdings used to fund partnerships, facilitate liquidity, and maintain the global corridors. Much of this is locked or strategically released through the escrow system. Because of this structure, retail traders are playing in a tiny sandbox compared to the scale of institutional activity. When large players need to move $1 billion or $10 billion transactions, they don't touch public exchanges. They go directly through Ripple's infrastructure. This explains why the XRP market often seems volatile at retail levels, even though institutional demand is quietly growing. Now here's where the price logic comes in. Many people assume that a low price is good because it's cheap. But in reality, a higher XRP price makes global payments far more efficient. For example, at $1 per token, moving $1 billion requires 1% of the circulating supply in a single transaction. At $100 per token, that same $1 billion transaction only requires 0.01% of the supply. The higher the price, the less disruption large-scale transactions cause, and the more practical XRP becomes as a bridge currency. Essentially, Ripple needs a higher price to power global liquidity effectively. The escrow system also plays a big role here. Out of every 1 billion XRP released each month, a significant portion is relocked, ensuring supply remains tight and predictable. This prevents market flooding and keeps institutional partners confident. In effect, the escrow system creates a safety mechanism. It's not about dumping on retail investors, it's about aligning supply with real-world demand. This two-tiered market also creates what I like to call a hidden value gap. Retail traders see a certain market cap and think they understand XRP's worth, but the real liquidity, the XRP actively moving through institutional corridors, is much more valuable. This hidden layer is what supports the projections we discussed in Part 4, including the $40 trillion scenario. The price and value of XRP are directly tied to its utility in moving real money at scale, not retail speculation. Finally, understanding this structure is critical for anyone who wants to play the XRP game strategically. If you only focus on retail movements, you're reacting to crumbs. Ripple, meanwhile, is negotiating the entire pie with central banks and major financial institutions. That's why the perception of centralization often scares people, but in reality, it's a controlled system designed for stability, efficiency, and massive scalability. Now that we've covered XRP's origin, escrow system, institutional adoption, and the two-tiered market, it's time to look ahead. What does all this mean for investors in 2026 and beyond? How does Ripple's strategy translate into price potential, and why is XRP more than just another cryptocurrency? First, let's recap the core idea. XRP isn't meant to be a speculative token like Bitcoin. It's designed as a global bridge asset, capable of moving trillions of dollars across borders in real time. Its price isn't driven by hype or retail FOMO, it's driven by utility. The more value Ripple moves through its liquidity corridors, the higher the effective floor price of XRP becomes. This is a revolutionary concept. Price is a reflection of real-world transactional demand, not just market sentiment. Here's the key for investors. Timing and understanding the structural shifts matter more than chasing short-term pumps. Retail investors often panic during escrow releases or minor price dips, thinking Ripple is dumping. In reality, the bulk of XRP is locked in institutional contracts or relocked through the escrow system, creating a predictable and controlled supply. The market moves when institutions need liquidity, not when headlines cause fear. Another major factor is utility-driven velocity. As more banks plug into XRP, the actual circulating supply available to retail investors becomes even smaller. In effect, XRP is becoming too valuable to float freely. The tokens you see on exchanges are only a small fraction of the real engine of value. This is why traditional market metrics often underestimate XRP's real potential. The hidden layer of institutional liquidity is what truly supports its growth. Innovation is also accelerating XRP's adoption. Ripple's stablecoin RLUSD, real-time settlements, and ISO 2022 compliance are all laying the foundation for a global financial network. These tools are not just enhancements, they are critical infrastructure that ensures XRP can handle massive transaction volumes efficiently and securely. This is why a high token price isn't a problem. It's a necessity for the system to function at scale. Now let's talk about the risks. XRP's greatest strength, its institutional backing, is also its most misunderstood aspect. Critics argue that centralization and control could be a weakness. Yes, Ripple holds a significant portion of the supply, but this control is strategic, not arbitrary. It ensures stability, predictable liquidity, and operational efficiency for global banks. Without this control, XRP would be unable to function as the backbone of the next-generation financial system. For investors, the takeaway is clear. This is not a retail trading game. Short-term swings are noise. The real opportunity lies in understanding XRP's institutional role, escrow mechanics, and bridge utility. Positioning yourself for long-term adoption rather than reacting to every headline is where the real potential lies. Finally, let's visualize the future. By the late 2020s, as Ripple's corridors expand further across BRICS nations, Europe, and Asia, XRP will increasingly act as the invisible engine behind global finance. Retail investors may never see the full supply in circulation, but the value is already locked into real-world contracts and settlements. The final escrow releases will create supply vacuums rather than market crashes. Every token Ripple holds is already committed to global liquidity operations. In conclusion, the XRP story in 2026 is about transition, infrastructure, and systemic adoption. Its escrow strategy, institutional corridors, and utility-driven pricing make it unique in the crypto space. For anyone looking to understand the real potential of digital assets, XRP is no longer just a coin. It's a cornerstone of the future financial system. The final question to leave you with, are you positioned for this transition, or are you watching from the sidelines? The choice isn't about timing the next pump, it's about understanding the mechanics of the new global financial architecture and your role in it.